might talk today a little bit about, we've heard a lot about the changes in rules, about the ability to take cash in your pension and take your money out. But there was a few thoughts around, well, now you can do it. Should you do it? Just a few thoughts on that. Now, whenever I do a lot of talks and dealings on pensions with financial advisors and solicitors and accountants. But to start my talks, I always go back and check and see what the press has been saying about pensions. And the Daily Express, for me, is my starting point. The Daily Express always has some headlines about pensions. I don't know if anyone knows, there was a website called Daily Express Bingo, where on that website it showed you the Daily Express has 5 subjects that it really alternates around sort of every week or so, and pensions happens to be one of them. The others, the weather, the royal family, how we don't like Europe, etc., etc. Those are the subjects. I always think it gives me a good view of what the world's thinking about pensions. Let's get away from all the professionals. Let's get back to your average man on the street and say what they're thinking about pensions. So we quite often get pensions slashed in rip-off. Millions now can't afford to retire. A bit of royal family. Pensions and savings, joy for all. And I always think it gives me a good sort of approach as to what's happening in the pensions world. I don't buy the Daily Express. I'll just have you let you know. I just see the headlines on the way to buy my Daily Mail. Now, I'm glad you laughed there. I did that line the other week, and no one laughed. And I thought, as I get older, am I turning into looking like a Daily Mail reader? Thank you very much. That was the headline straight after the budget. So this idea that you can now cash in your pension, pensions and savings, joy for all, good news for makers, doers and savers. And George Osborne quoted as saying, let me be clear, no one will have to buy an annuity. Well, that's not strictly true. We haven't had to buy an annuity since 2006, strictly. But I think this time people really took on board this issue of annuities. And I think there was a much more fundamental basis of why people didn't want to buy annuities. And this got me into trouble at home. When the news at 10 came on and the headlines came up, new legislation, don't have to buy an annuity. I'm shouting at the television, but that's been the case for years. My wife turns around to me and tells me to be quiet and stop shouting at the television. Then she apologised to all our guests. And then we carried on with dinner. But I think we haven't had to buy an annuity since 2006, but I think a combination, we've almost had the perfect storm come along with low annuity rates and examination of the annuity market. For me, annuities are good. They still form a part of a retirement portfolio, but perhaps a different time, a different place. Perhaps we push them a bit further back, and they are your reliance against living too long, your insurance against living too long. So we've got freedom and choice in pensions, as Steve Webb was eloquently talking about earlier on. And he did mention the Lamborghini. Under pensions law, I have to have a picture of a Lamborghini on the screen. I know he doesn't want to be known as the Lamborghini minister, but it does show this thought about what people have been spending their money on. I know it's early days yet, but these new rules started in April. Always interested in a pension story. I've been canvassing a few people to see what people have been doing. So I've heard one guy who took a large chunk of money out of his pension to buy himself a Porsche. Not quite a Lamborghini, but a Porsche. One story I had was one guy took a large chunk of money out of his pension to buy himself a Thai bride, which I thought was an interesting examination of but you're making your money work for you. The other end of the scale, I had, someone suggested to me to come with a 5-year guarantee, and I realised I'm not sure about that one. Someone also suggested to me, there was a lady in a hospital, a nurse, she'd taken some money out of her pension to buy a pony for her granddaughter. So you go from one end, all the extremes. These are the sort of stories. I think we're early days yet, but should people be taking money out of their pensions to spend on consumer goods? I guess my view is it's about utility, isn't it? If you've got a small pension sum, and that sum, if bought in an annuity, wouldn't provide you with a life-changing level of income, why not enjoy yourself with that money? If you've got a large pension fund, or you're looking to sustain the income through lifetime, and that's your only assets, perhaps you need to be a bit more careful about it. So there's no hard or fast answer, but I think consideration needs to be given across the board as to, if you do live to be 100, what are you going to be living on? And that's the key for me. Who's going to stop paying you when you stop earning? Your income is your pension and your other assets. So let's look at that and look forward as to what you want to achieve with those other assets. And if you do take your money out, there's always a few people who will be very keen to take the proceeds of you taking that money out. And there has been suggestions that some of the numbers that came out from the Treasury have suggested they are expecting quite a large tax take. And you can tell they're very keen on getting quite a large tax take from people taking money out of their pensions. So what do consumers want? Well, what do I think consumers want, or what does our industry think? Perhaps a bit more access to funds, dip into funds as and when they're needed, More money perhaps in the early years of retirement. There is this idea of a U-shaped curve of spending in retirement. When you first retire, you pay off a mortgage, buy a house, buy a car perhaps, go off and pay off some debts. It goes down as you settle into a spending habit and goes up again when you come around to long-term care or assistance needed. Certainty of covering basic living costs, security of not running out of money, and flexibility to change. And I think the new rules bring about all those. The danger is, I guess, if you take your whole pension fund out as cash, that's when you lose some of that flexibility in the future. And for me, the issue here, the one bit we can never legislate for is the date that you're going to die. So you're always going to know that you may live to be 100, you may live to be 90. What's going to sustain you across to those particular ages? Well, age 55 is the earliest you could take it when you retire. But what is retirement? I mean, that used to be retirement, didn't it? And I got a bit fed up with our industry. Either that picture was a picture of retirement, or it was a picture of two people walking down a beach with a beige jacket over his shoulder. That's what all the advertisements always seem to have had. Retirement is a multitude of different things, I think, now. It can be holidays, it can be time at home, it can be bequests, it can be time with the family. So I think there's a whole raft of different issues around what retirement actually means. And it's not just full retirement anymore. Often it's partial retirement, to move gradually into what's termed retirement. Now, I did like that one. I thought Bob Monkhouse's view of retirement was actually quite a good... when I first saw that, I thought that was a great line, actually. And so I had to sort of get that in if I could. I think for me, retirement's a little bit more like that, isn't it? High initial income, possibly declining with age and activity, a minimum income floor, something that that's the hardest one of all, is to identify that level of income below which you perhaps can't sustain what you do every month, every week. And then possibly, if you're lucky enough, perhaps a bequest to pass on to the children or the grandchildren. So for me, taking it away from everything else, that is my diagram almost of what a retirement could look like. So what can you do now? Well, you can take a lump sum. We've had all this earlier today. You can take a lump sum with the first 25% tax-free and the rest taxed. You can go into drawdown and manipulate your income tax efficiently as you go, or you can buy an annuity. And there are pros and cons of each. But what the new rules have given us is that ability to do all or nothing. And for me, it's choice of the individual, which has really come through the new policy. So should I take it out? Well, my first question would be to ask, why? Now, have a reason why you want to take it out. I was talking to someone recently and I said, well, I said, you've got a pension, haven't you? He said, yes. I said, what's it invested in? He said, don't know. Is it performing very well? He said, well, don't know. I said, well, why do you want to take it out? He said, so it performs better. And that, to me, I saw there's some logic missing here, isn't there? Not sure where it was, not sure what it was doing, but the concept is that by taking it out, it will do something better. And I've got my 5 golden rules that I've developed, really, which is, do not take it out if you don't know what you're going to do with it. Do not take it out to invest in something you could have invested through the pension scheme. Because you've got your tax-efficient pensions wrapper. Why take it out and invest it into something that you could have done outside the tax-efficient wrapper? You could have done inside the wrapper. Understand the tax. Come back to that. The tax, for me, is key. Ask yourself what you'll do if you live to a ripe old age. How's that going to sustain your income? And if in doubt, take professional advice. So those are my 5 golden rules. And I guess my 6th golden rule would be to, whenever you think about taking it out, go back and ask yourself those questions again, just to make sure. I think Steve Webb once said, I think the 6th of April this year wasn't a deadline, it was a starting date. Remember, it's not a deadline. We've got plenty of time to do these things. Make sure you get the plan in the right place. Speedboats, cruises, holiday homes, all sorts of issues around people want your retirement money, I think. And people are spending money on retirement. The Sunday Times, just before Christmas, had its travel section was based on trips of a lifetime on which to splurge your pensions money. And I think there'll be a lot of advertising around looking towards people want your pension money. Well, they would, wouldn't they? But so do you, really. You might want it longer than they do. So it's very careful to just think, speedboats, cruises, holiday homes. One I had recently was a guy said to me, my brother's going to take out a large chunk of his pension money when he gets to April next year. And I said, what's that? He said, well, he's always been meaning to have his teeth done. And I said, sorry? He said, well, he's going to take out £35,000 and have his teeth done. And I thought, that's an interesting one. I suppose utility. I mean, you would do if it came to the crunch, wouldn't you, I suppose? Well, thank you. When can I get my hands on my money? Age 55 at earliest. And there's been lots of stories around about people almost buying the cruise, buying the Porsche, going along and saying, right, that's it. but you're not 55 yet, you're only 35. Oh, I didn't realise I had to be retiring. So age 55 at earliest, possibly going up in the future, perhaps in line with what Steve was saying with regard to state pension age. And, property is another big one. Questions about, should you take your money out and invest it into buy-to-let property? And again, was alluded to in the panel earlier on, there are lots of tax inefficiencies on that, I think. And lots of, someone once said, I think, that buy-to-let isn't necessarily an investment, it's a business. You need to be aware of the implications. I did see a good article, which was almost the reverse, which was if you've got a buy-to-let today, perhaps today it's a good thing perhaps to sell your buy-to-let, crystallise the taxes, pay the proceeds back in as a pension contribution, and get your full pension tax relief. So you've offset the tax you pay on your buy-to-let, your CGT, etc., by putting it back in and getting full tax relief again. And that attracted a little bit. But everyone's becoming an expert. So this was, funny enough, it was an estate agent about 200 yards from where I live. And they're having seminars about pension reforms. I'm quite tempted to pop in and ask them some questions, actually. But they are very much trying to get this idea of people will take the money out of the pension, use it to buy-to-let. The tax implications are very important. It's back into your estate, there's capital gains tax, etc., etc. There's uncertainty of income, and there's a whole raft of other issues, I think, around buy-to-let. For some circumstances, it might work. It might be an appropriate investment. I don't think it's necessarily for everybody. And then I go back to longevity and this whole thing of how long are you going to live and what do you want, what sort of income do you want along those years? Do you want to stay? More people will get a telegram. Actually, it won't be a telegram anymore. It'll be a text message, I reckon, in the end. There'll be so many people for this. You'll have a list of preordained, or you might even go onto the Buckingham Palace Facebook page or something, just saying congratulations to all these people. But let's look at again longevity. We all see this longevity. What's this? This is for a woman, female age 65 in the UK population, life expectancy 24 years. So you'd think you'd be able to plan perhaps towards that, a nice life expectancy up to 90. But then you work out that the chance of living beyond your life expectancy is 55%. We tend to underestimate how long we're going to live, and yet all the figures we get are only averages, and therefore we know that if there's an average which says you're going to live to the age of 90, there's always going to be a few more people that live beyond the age of 90. So I think longevity is a key issue. Make sure you've got some indication and some planning, just some forward planning, I think, as to do you need your pension resources and your other financial resources to last across that period of time. And then tax. Tax is very important, I think, this whole issue of understanding what tax you're going to pay on the money you take out and the danger that you will pay a lot more tax than you think. And I'm very much of the view that if people do take out money for specific purposes, they just understand perhaps there might be some flexibility. I had a case recently of someone was saying, Mike, I've only got a small pension fund, but I quite like 5 key holidays, 5 cruises perhaps over the next 5 years. So I want to take the money out and pay for those cruises. The key point was, don't take out your money for 5 years, take out a fifth for the next 5 years and utilise your appropriate tax planning opportunities. So even if you've got a plan to take money out, take your money out in a stepped way to use the tax efficiencies that you've got over a period of time. Now, I apologise for the next couple of slides. I won't go through them in great detail. But should I take it out? Just some assumptions, and I guess the copies of slides will be available. But what it almost concludes is remaining will be total tax bill, 53,643 in that example. Yet, if he decided to take the funds over 5 years, he would decrease his tax considerably. So just understanding the tax, let's not use that as an example, but let's just use that as a way of saying, let's not take out 5 years' money in advance, let's take it out over 5 years. It makes more sense to me. Even with a small pension fund, this was a small pension fund of 60,000, takes the full amount as a pension lump sum, total tax £7,500. Instead he took the funds over 5 tax years, he could take the funds without paying any tax at all. So there's a bit of tax planning, a bit of tax understanding in there, for me, that's key. And just planning beforehand. Understand perhaps if that's your curve of income, likely in retirement, perhaps in some years you're going to be well below the 40% tax threshold. Should you take more money out? Well, why not take a bit out up to the 40% threshold? And in some years in the future, if you're above the 40% threshold, perhaps you might have put that money into an ISA, perhaps. So the ISA money coming out is tax-free, so you're above the tax threshold, but you're still paying basic rate tax. So understand the way the tax rates work, I think, and make them work for you as against you, I think, is the key. If you want some guidance, and it's been mentioned a number of times today, we have PensionWise, and they will answer your PensionWise. I think they're there to give you some indication of almost a decision tree about what the options are available to you, and then perhaps point you, if it's a bit complicated, in the direction of financial advice. And, as has been said many times today, watch out for scams. If it looks too good to be true, it probably is too good to be true. And over the years, I've seen some great ones. There's been all sorts. For another talk I was doing, I Googled some of the investments that were available for pensions, and I came up with one that's perhaps not so attractive today, was Ukrainian farmland. Nice little apartment down in Grenada, Chinese bamboo forests, all sorts of different investment opportunities are available. But I would say if it looks too good to be true, it is. And look for that word regulated in the description of the investment and/or the company that's recommending the investments. I know the FCA have really tried to, the freedom is there to take money out, but let's have a bit of control of perhaps over what people are doing with it. And there's all talks of cold calls and, as has been said, I won't reiterate what's been said today, but I think we've had enough examples today of how many scams there are out there. My key one, I guess, to leave you with is this point that will your pension pot last as long as you will? And for me, that's the difference. The ideal, as someone once said to me, is that the day you die, you've drawn out a cheque that's slightly larger than your pension fund and it bounces. That's the way you'd like to get to. But having some indication, look at some cash flow forecasts, look at some indications of how long you might live, look at what income you need, look at the security of that income. And look at this idea of investment risk, willingness, ability, need, and you get this sort of true client risk profile. It's not about sort of picking a random number. It's sitting down, thinking about your lifestyle, thinking about the actual investments you'd like to invest in, then applying that willingness, ability, and need. I think from there, with a balanced approach to it, you'll probably come up with the right answer. Back to the Daily Mail, day after the budget, pension power to the people. So the power's there. Everyone's got the chance now to look after their own pension fund, but get it wrong, and those two are there waiting to take their fair share or unfair share of your pension fund. Thank you very much for your time.